Everybody to our education event, I guess we've labeled it, which is on valuing ventures. And our objectives today are basically just it'll be a review for some folks, it'll be new to some folks. So it's basically to familiarize more of our members with various valuation concepts, a lot of the terms around valuation, and both used in equity financings and in convertible debt financings. And we're also going to basically give people a feeling for the capital strategy that companies follow as they develop from very early seed stage on out to a sale of the company to somebody. And we have an example which builds that up and shows everybody what happens to the equity stack of a company as they transition through various share issues. We'll spend some time, Stephen's going to spend some time talking about cap tables, and so people can know what they're looking at when they get those. And then Alan Litwin's going to be talking about the HALO report, which is an Angel Capital Association report issued annually, which talks about current trends, pricing, where new deals are priced, and we'll familiarize people at the beginning with how that's done. And your presenters today are Dan Cromie is going to kick it off, and then Ella's going to take a piece, then John Zinno. I'll do the example of a company, and Stephen Schweik will talk about cap tables, and these all have related concepts around them, and then Alan Litwin will finish up. We're going to target the talk for about 50 minutes to an hour in our various pieces, and then we'll have plenty of time for questions and discussion thereafter. So with no further ado, I think it's Dan, you're up on starting on page 2.
Sure. All right. So just a really quick introduction. My name is Dan Cromie. As Rob said, I've spent the last couple of decades in private equity, most recently as a partner at a firm called Atlas Holdings. We're a $6 billion private equity firm based in Connecticut that's focused on control investments in basic industries. And over the course of those past couple of decades, I've spent a lot of time valuing companies, assessing different approaches to valuation and developing a point of view. And I think for those of you who are new to all of this, it's important to note that valuing companies is both a science and an art with quantitative and qualitative methods that get employed. And it's not really like a math problem where you say there's only one answer. It's more of an opinion, and hopefully a pretty educated one that's in the eyes of the beholder. And if both parties, the buyer and the seller, can agree, then a transaction happens. But the process here is, how does one develop that point of view? We're going to talk here about two primary methodologies. One is a quantitative approach, the other is a qualitative approach. For mature companies with a historical track record of revenue and earnings, a well understood positioning in their industry, and well understood growth prospects, there's a whole series of quantitative analyses that can be utilized based on a set of assumptions to come up with a present valuation of a business. And when you hear like the word, a quant hedge fund, I mean, these are what these hedge funds do, like a Bridgewater. They are, taking financial information from a host of different inputs that, can be publicly available or purchased, and basically putting these assumptions into models to try to determine what is the current value of a business that you'd be prepared to transact at. Some of the methods that are quantitative methods are like looking at a discounted cash flow analysis. You might have heard of that. That's sort of saying, what if I took the future cash flows of a business based upon a set of assumptions, and I discounted those back at a discount rate, what would the net present value of the business be? Usually assumes the ultimate sale of the business at a terminal value, which is another term of art. We'll talk about terms of art. Another methodology, it's like a quantitative mathematical model, is the Black-Scholes formula, the Black-Scholes model, which is looks at valuing options predominantly by taking into account future volatility and timing of an option held. It's a long way of saying there's a whole host of ways that you can value a business in a quantitative method, but it's typically utilizing assumptions that are based upon readily available public information, plugging it into a mathematical formula and deriving a value. that can change pretty dramatically depending upon what assumptions you use. So that works really well for mature companies or companies that have public information and a historical track record. Doesn't necessarily work so well for companies of the ilk that Cherrystone's investing in. You know, Cherrystone's investing typically in companies that have a great idea, have a product, or is working towards getting a product on the market, typically pre-revenue, very little track record. In those circumstances, typically qualitative methodologies are utilized. And this is where, you know, you have to make initially sort of a key assessment of the drivers of potential value creation. You know, is this company differentiated? Does it have a high value offering? Is the market size compelling? Is the scale of the opportunity compelling? Is there protectable IP? How good is the team? You go through all those due diligence, and then once you get there, those key assessments, you say, okay, let's go look at the market and see of other companies that are comparable to this company I'm looking at now and its condition. What are comparable transactions and valuations that have been placed on those companies? And how can I apply them to my view of this company in particular? And that's why we think, you know, it states here in this slide, qualitative method, it's traditionally based on a market-driven valuation. What's trading in the market today in a comp set versus what's my expectations of sort of a future mathematical formula of the earnings of the business. You can switch to the next slide, Ella. Alan's going to talk more about that, some of the current market valuation metrics that Cherrystone will utilize when it's in its target investment categories, and that's predominantly the mechanism we utilize. In any profession, there's lots of vernacular and terms of art, and that's also the case here when you're looking at valuation and finance. So just to cover a couple of helpful terms of art. Equity is the ownership of the company. Think of buying shares in a listed company or on an exchange, or being given stock options. The only, I think, nuance in angel investing is the equity purchased or granted is typically pretty illiquid. You can't just go and say, I bought Microsoft stock, I want to go sell that and get my cash. So it can't be as easily traded or exchanged. And it also, as a result, its valuation's trickier, right? Because there's not an active market to go sort out what the value of the business is today. Convertible notes is a form of debt that converts into equity at a future date with specific parameters on valuation. And it's something that can frequently get used in very early rounds of investment because it provides for a conversion at a discounted price to a future equity round and places a cap on that valuation. And Ella is going to talk more about these types of investments later on in the deck. Pre-money valuation, that's a term that will get utilized a lot when you're hearing about potential investment opportunities in Cherrystone. This is the value of the company before any additional investment goes in, so before the next round. And this is typically how a company that's raising capital is discussed in terms of its value. The post-money valuation is the value of the company after factoring in the cash raised in the current anticipated fundraising round. So a simple example would be, let's say there's a new company out there that's been presenting to Cherrystone, Widgets R Us, and they're seeking to raise $4 million. And let's say after a negotiation, the pre-money valuation is determined to be $12 million. So that's basically the basis upon which both parties agree a transaction can occur. In that circumstance, the post-money valuation after closing on the incremental $4 million of capital will be $16 million. Investor percentage equity, next slide, Ella. In the same example, the new investors would have invested $4 million on a $16 million post-money valuation. And so their investor equity would be 25%. Price per share. This is another term you'll hear utilized when discussing valuations and transactions and investing. Let's say in the same example that there were 1.2 million shares outstanding of Widgets R Us prior to the $4 million round. The pre-money valuation of this business is 12 million, which would put the price per share at $10 per share. And the new investors would purchase 400,000 shares. And so the total shares outstanding after that round would be 1.6 million. So that's how price per share sort of factors in. Two other just quick terms of art that you'll maybe hear in the context of talking about valuations. Enterprise value. This is another way of talking about the total value of a business, as in this is what a buyer of a company would pay to the seller of a company for 100% of that company. And it's basically the equity value of the company plus any debt outstanding less cash outstanding. And that's enterprise value. Terminal value is another term that you'll hear. And this is really the value of the equity at the time of a sale or a liquidity event, when the investor is cashing out of their investment. And it's usually utilized in the context of saying, you know, we hope that this business gets to this point of value where the terminal value of our investment will be $X. It's utilized as well as an assumption in some quantitative methods that we previously described for assessing, like in forecasting, what is going to be the future cash flow stream that I want to discount to arrive at my current valuation of the business. So hopefully that's been helpful to kind of frame things. And with that, I'll turn it over to Ella.
Thank you, Daniel. Before we dig deeper into valuation, we thought it would be useful to explain the different types of securities. So as angel investors, the different securities are generally divided into three categories. The first one is convertible notes. Second one is equity rounds. And the third one is SAFE. What are convertible notes? Convertible notes are debt instruments and in that you usually will hear things like maturity dates, interest rate, etc. And these notes will convert into equity at a certain time in the future when the next round, when the round, it could be the next round or it could be the first round, is raised. So when are these used and what are the typical use of them? Convertible note a lot of times is used when the company is not really ready to raise the series, either it's A or B. It's some sort of like a bridge loan. Perhaps it's their first round and they're not really ready to put a valuation yet. And perhaps it's in between rounds and they just need a quick financing before they reach the next milestone to raise an equity round. Whichever is the case, the convertible note is a debt. Usually it will be a smaller amount than the equity round. So it can be $500,000, $1 million typically is the amount. And it will have a discount usually and a cap. The cap says what is the maximum amount valuation that the company, that the note will convert in a future round. So if the company is not really ready for a raise right now valuation to put a value on the company, and they're not ready to say the company is worth $7 million now, perhaps we will say, okay, we will have a convertible note and we will put a cap of $7 million. And in return for the fact that we are investing before early and we're taking the risk, we will have typically a discount rate. So it could be 15%, 20%. It could have no discount, but typically it will have a discount. That is kind of the reward. And in addition, you'll usually see some sort of a dividend. The dividend is, because it's a debt instrument, let's say it's for a year, 2 years, it will typically have a dividend, which is the payout for the debt, let's say 6% a year. At that moment in the future, when the company raises Series A and it will convert, they will also have to convert and pay out the dividend. The second type of financing is an equity round. This is really the preferred way of raising money for angel investors. It's the most secure. You know what you're getting, you know the valuation, you're getting the shares. Really, we are not, angel investors typically do not invest to be a debtor or invest in a short-term debt. They really want shares in the company. They want to be part of the growing and to grow the company and make a nice multiple, ideally. So equity round is really what we all aspire for as angel investors. And in that, you will have the valuation of the company, you will have a price per share, which is the same thing as basically putting a valuation. It's the number of outstanding shares times the price per share. and that will have the valuation. It will have which category of shares this round is raising. It could be preferred A, could be preferred B, preferred seed, depending on the round. And it will have all kinds of different rights that will go over the main category on the next slide. We talk about term sheet. The third type of security is SAFE. This one is probably the least common and the least preferred for investors. And that's because it's neither a security nor a debt. It's neither equity nor a debt. And what does that mean? The SAFE gives you supposedly a right to convert in the future on certain occurrence. And that occurrence might or might not happen. So the conversion might happen, conversion might not happen. And the SAFE is also not a debt. So in a way, there's no protection, common law protection. There's no liquidation preferences. There's no protection as a debt holder. So it's kind of like a very insecure type of note for the investor. It's very safe for the company, but it's not so safe for the investors. Still, there are times where it's appropriate. It's pretty common in the West Coast. A lot of companies insist on that. So depending on how desirable the investment, perhaps the group decides to do it. But it's a little uncommon with Cherrystone and a lot of other groups. So term sheet. A few words about term sheet, and I'm sure that a lot of you are familiar, some might not. This certainly isn't going to cover everything on term sheet. You could say a lot about term sheet, but just to cover kind of the main categories. I think not a lot of people know that term sheet is actually a non-binding written document. And when I say non-binding, it means it doesn't, if you take it to court, it's not going to hold. Really what it meant to do is summarize the deal terms. So sometimes it's before a company or an angel group does a very deep dive into due diligence. That is a lot of work. And if we don't agree on the basic terms of the deal, then maybe we don't want to do all the work. Also, it's quite costly to go into the full set of legal documents. So a lot of times you would agree on term sheet first, make sure that we agree on the categories. And after that, finish the due diligence. Typically, it's negotiated at the same time of the due diligence and then execute the full legal documents. The key terms usually defined in the term sheets, you'll have the amount raised, price per share, pre and post money valuation that Danielle covered, or a cap, and any discount or dividend if we're talking about a convertible note. Other key terms that you'll see a lot of times in term sheet, if we're talking about an equity subscription agreement, you will typically see whether we get a board seat or not. It's very desirable for an angel group. Sometimes it will be stipulated on a certain minimum investment. So if we invest 200 and over, we'll get a board seat. That board seat can be either an observer or a full voting one. Voting rights will define whatever voting rights the category of shares we're invested in will get, whether it's a preferred A, preferred B. It's a category that is created for that round. And whatever voting rights are attached to this category will be stipulated in the term sheet and then also in the full documents. Anti-dilution rights, you'll find the term used. What it really refers to is your right to get an additional amount of shares and preserve your certain holding in the company when further rounds are happening. So if you're holding 3% now and the company continue to raise money, if you don't have any anti-dilution rights and you don't have the right to either receive more shares or have the preemptive right to buy more shares, then you're going to get diluted. Liquidation preferences is where It will state how the proceed of the sale will be distributed. It could be your rights in a sale. It could be if the company basically goes bust, but basically it will determine the order by which people get what. So preferred shares typically will be first to get, and it will be by category, but preferreds will get first the money out of the proceeds, and then we'll go to common. A lot of times, and the liquidation preferences will also trigger the conversion of the preferred shares into common, and either they will have a double dip or no, it could either be a participating preferred or a non-participating preferred, but typically whether they're participating or not, they would at least get one-time value, and they will get it before the common shareholders. The syndicated averages refer to how the deals get syndicated. Typically when we get, unless we're talking about a convertible note that is low or a seed round that can be relatively low, like $500,000, typical sizes will be, if it's a seed, $500,000 to $1 million, could be more. Series A will typically be $1 to $3 million. That is more than one group will be able to buy it by itself. So a lot of times we will be syndicating it. We'll first see what the group wants to take, and then we'll syndicate it to other groups. A little bit about averages, and Alan will go over at the end more. The current average for seed and Series A as of 2020 is 6.8 million. So that kind of definitely changed in the last 10 years since Cherrystone has been investing, and put definitely our last several deals in the light of a fantastic valuation. Series A investors generally hold 20 to 35% of the company, and if the investors think that the company is going to need a lot more money in the future, then typically they want to start with a little bit more of holding, because as the company goes through more and more finances, that percentage gets diluted unless you add more money. And in that, I will pass it to John.
Great, thanks, Ella. Hi, everyone. I'm going to spend a few minutes talking more at a macro level about valuation, how we value these startup entities, especially in the earlier stages. And like Dan mentioned before, it's definitely more of an art than a science, but takes a bit of a mix of both the qualitative and the quantitative aspects of trying to understand how do we value these, and how do we pull it together and come up with what we think the anticipated value is today at an exit, and how we see that progress over time as the company goes through further rounds and raises further capital to get to that exit. So anticipated exit valuation, I'll spend a couple minutes on this slide talking about each one at a high level, then we'll dive deeper into a couple of the topic areas. So this is really the liquidity event for angels. How most angels get their money out of an investment is that an exit. So when you look at this in conjunction with some of the things Alan will talk about in terms of rates of return that you desire. I mean, given rate of returns are zero now, that's why our valuations tend to be higher than we'd like to see in the early stages. But I think we're able to look at and say, here's the exit value, here's what we see up as an upfront and kind of our desired rate of return as an angel group. I think second, the total capital requirements and the likely sources. It's a couple things to think about here is what capital does that angel need to get to the next inflection point? If you're thinking about a drug development company or a med tech company, what do you need to get to that commercial stage and get through your clinical trials? If you're thinking about a tech company, what do you need to get to a certain level of ARR when you can have that inflection point and raise your next round of capital? And then really, what do you need to get to an exit? And we think about that kind of in pieces as well as through the entire stretch of start until exit, so we can come up with A, where does our value need to be today? B, what dilution are we going to get along the way? And C, what can we expect to get from a time perspective to that exit? And capital sources can come from a variety of different areas. It can come from angels. As we've seen in the last couple investments, Amcell, ASG, they've been able to get non-dilutive grants and financing, which is free money for angels. And that's a great thing to help you build the company without diluting down your equity. And of course, from the company themselves as they generate revenue and grow. The next is the key hires requiring future stock grants. I think this is pretty critical when you think about two things. One, the actual founder themselves. keeping them with enough equity to be incentivized to want to grow and develop the business and help them. And then also giving them the toolkit to help bring on key talent, key hires, and have that option pool available. I mean, if you think about investing at this stage, we're really investing in the people and the IP. That's what the company has. Those are the two most valuable assets of the business at the time that we're coming in as angels. And so we want to make sure that those assets are protected and taken care of, and we validate those in due diligence. And that's one of the key things in diligence that we focus on. And then potential terms of this round and later rounds, I think Ella hit upon it a little bit in the last slide in terms of what we like to see in term sheets, some of the key parts of the deal. But this kind of helps codify the valuation in a document and gives us the investor the protections they need to be able to invest comfortably and understand what they're getting for the investment. Ellie, might turn to the next slide. Talk a little bit about exit valuations. So again, back to the whole art and science piece of it. I think 1 and 2 is an area that we spend a considerable amount of time in due diligence. 1, in terms of determining the exit timing. We say 5 years is a typical assumption, but I think we can attest that it's usually longer than that, and we've probably held on to some longer and shorter than that period. But 5's a rule of thumb. But you need to consider the key growth aspects of the company. So if it's a company that has to go through certain regulatory hurdles, how long is that going to take? What are the various phases of development look like? And how long is it going to take for market adoption? And we ask that question quite a bit. We think about due diligence is how you're going to get the product to commercialization, how you're going to get it through sales and to a point where you're going to have enough revenue for an investor to look at you credibly. The second piece is the projected revenue at the time of sale. When you think about a company at the time of sale, how much revenue do we expect that they'll have? What expected, and this ties into number 3, market multiple will there be? Like we said before, it's easy to value established companies that have recurring cash flow and use a discounted cash flow model, and you're able to build a valuation for a business. When you're looking at these startups, you need to use kind of shorthand, more multiple based approaches when you get to the year 5 and year 6 projected revenue. So that's what we do. We use EBITDA multiples, we use revenue multiples to come up with what do we think the valuation will be at that time, and then discount it back to try to understand what return we can expect for the early stage investment and taking on that risk as an early angel. And so just thinking about it from a value perspective, to put some numbers to it, we think a company is going to have $10 million in revenue in year 5, and that $10 million of revenue can be sold at a 3x multiple. We think that business in 5 years is worth $30 million. And so today, if we want to get a 30 to 40% return on our investment to compensate us for the risk that we're taking, that investment today will need to be somewhere in the $5 to $6 million range. And so using shorthand and rule of thumbs like that help us establish a value for the company, and then we tie that into liquidity needs and dilution and the other pieces of the valuation as we think about it over the coming years. Next page is on the capital requirements. So this is another important factor to try to understand how much cash does a company need to get to that exit. Whether it's, and we talked about a little bit before, non-dilutive financing, so grants in the company's actual sales that they're going to make from inception till when they get to the exit, and then dilutive financing, so other angels. And we'll typically look at it in terms of inflection points. And so thinking about when a company gets to a certain level of recurring revenue or a certain regulatory hurdle or milestone, we can take a step back and say, what will that company be potentially worth at that time, and what round can they raise at that time to help us keep ourselves from getting diluted if they need more capital. You want to balance the amount of capital being raised to not too little that round will have to get raised very quickly, and not too much that entrepreneur and that founder doesn't have some kind of capital, too much capital on hand and starts to get reckless with some of the spend. So you want to have a good balance of not too little, because they always need more than they ask for, but not too much, because you don't need excess capital on hand if it's not what it takes to grow the business. And then looking in terms of the assessment through diligence of when does the company get break even, and do we believe that that's the right point in time when they get break even, and if it's not, making sure they have the right capital buffer to get to that next round, which is pretty key. And then the third piece, the next slide, is key hires. So like we said, we want to make sure that that founder is incentivized to have skin in the game with the company. And so we always want to look back at the cap table, and Rob's going to take us through the example of the cap table, but make sure we understand what the founder has, both their own equity to keep them incentivized, and then what do they have for tools in their toolkit to keep other key executive hires incentivized and aim toward growing that business. So option pool is a key thing to put in most negotiations that we have, and in most rounds that we raise. We want to make sure that that option pool is set at a place where it's not overly dilutive, but it's giving the company enough to incentivize folks, and making sure you just tie into the term sheet and some of the key terms, that if we do have board representation, that we're able to help think about the options and how they're granted, and that they're being used in an effective manner in advising on the board. And I think that the last slide of the valuation is kind of how it all comes together. And it's really kind of the term sheets and the investor agreement. I'll spend a minute on this because I know we've covered it in a couple other sections, but understanding the deal economics. So understanding everything that we do in the valuation needs to be codified in the document, because that's what connects it, and that's what keeps us protected as investors. So how big is the round? What is that pre-money valuation, that dollar per share valuation that we're buying into? What is that liquidity preference? Are we going to have a preferred where we're going to get top of the capital stack and get a certain rate of return on our money, which lowers our risk and helps with the valuation? What that option pool looks like, what do the dividends look like? Making sure as investors we have the right rights and protections. So approval rights, participation rights, anti-dilution, which I didn't hit upon before, but when you think about the cash needs of the business, if they do need future rounds, you may want to make sure as an investor that we're not being diluted down to a point where our valuation and our rates of return are going to change dramatically. So making sure that we have some of those protections in there as investors to make sure we maintain the right level of control over the return. Management and control. So back to a lot of the investments we make recently, when you lead the round, you typically raise enough capital, or you can't get a board seat. You can't have some of the rights on information, understanding how the founders vest, assignment of IP, non-competes, and the like. And then exits and liquidity. Back to what we talked about before, making sure that we have the understanding of how that cash flow works at the end. What does that exit event look like, and kind of what rights we have as investors to make sure we get the right amount of capital at the exit to get our return. And with that, I'll hand it over to talk through the valuation to Rob. The example.
You're on mute, Rob. Rob?
I think you're on mute. There you go.
Let's try that again.
Okay.
So what we've done is we've put an example together which captures some of the concepts you've just heard about, but walks you through a company which starts out early, goes through 3 rounds of capital raise, and then goes through a sale. And we'll let people take a look at what it actually looks like. And this is this opening position. You'll see on the right the assumptions here. XYZ Corporation has 2 founders and a 10% option pool, and they need to raise a $1 million Series A. And after discussions with them, and this is what they think, and we've talked to them, we agree that there's a $2.5 million pre-money valuation is relevant. I will tell you that a lot of the math works in this example. It doesn't usually, but a lot of the math works in this example. And in addition, just to sort of tune people up, the company also has a $250,000 seed convertible note, in this case with no cap. That's actually pretty unusual, but that was the way this example was done originally. We're gonna roll with that. So this is your starting position, and this is very common for what we see with very early stage companies coming in. This is sort of what they look like. All right. Next slide, please. So now the company's thinking about doing a Series A. Now the pre-money valuation of the company, you may recall, is that you have 2 founders. The $2.5 million pre-money valuation, 2 founders, each of whom have 1 million shares, All right, and you can see down at the bottom, and this is for the earlier slide, the pre-money, the price per share is the pre-money valuation of 2.5 million divided by the fully diluted shares. And there's an option pool plus these shares, and that's 2.2 million, and you do the math, and it comes out to $1.12.5 per share. So when we're raising the Series A, we're going to be raising it at $1.12 per share. Okay, next slide. Now we do the Series A, and the Series A here, my notes, is $1.25 million, and you can see that in the middle of the cap table of proceeds. And this involves, this has two levels here. One is there's a Cherry Stone example here that we're investing $300,000. And you can see if you go in, you see the pre-funding cap table, which is the middle column, and then the Series A, which is new, and you've got the number of shares there and the proceeds. And you see Cherry Stone's coming in for $300,000, and the other investors, including the conversion of the notes, is $950,000 for a total of $1.25 million in proceeds. Now you take that $1.25 million, you add it to the $2.5 million that was the pre-money valuation, you're going to get to a $3.75 million post-money valuation. That's that block up the top that says company valuation. And then you can see, if you look on the right, what happens to the percentage ownership shares of the different categories. You can see the two founders each originally had 45% of the company. They each now have 30% of the company. The option pools dropped in total value. And you can see the Cherry Stone's investment, which is part of the Series A. Cherry Stone has 8%, and the other investors, including those who held the seed notes, have 25%. So the founders have dropped down to 66%. This is very common, a very common result for an A round, where basically they've got to give up about a third of the company to raise their funds. Okay, next slide. Now we get into a Series B. All right, and the Series B, after discussions, you may remember the pre-money of the last round was 3.75. Well, the companies went away after the Series A, and they did a bunch of work for about a year. They did what they were going to do. And now they've come back to raise some more money. They want to put 2 million shares out of additional money, and 2 million shares out, sorry. And they decided that the company is now worth $5 million. So that's a step up in value. All right, that's not a dollar for dollar transaction. That's if people say this company's now worth $5 million. That means that the value of each share has gone up. Okay, and the way you can see the pre-money value now at 5 million, and we had before from the prior cap table 3,333,000 shares. Okay, the value per share is now up to $1.50. You may remember in the A round, the value was $1.12.5. It's up to $1.50. Okay, and you can see that category over on the right in that little box. You can see that summary. All right, now they're doing $2 million at $1.50 a share, 2 million shares at $1.50 a share. They're raising $3 million. So the post-money valuation of the company after this B round, you can see it down in the bottom brown box, will be $8 million. Okay, that's the old shares plus the new shares at $1.50 a share. There's now 5.33 million shares outstanding, and the post-money valuation is $8 million a share. All right, and in the middle box there that you can see where it says pro rata calculation, that's how much you would have to invest if you were Cherry Stone, how much we would have to invest to maintain our ownership percentage where it was in the A round. Okay, so this is what a step up in value in the B round looks like. All right, and Ellie, you can go to the next slide. And this cap table will be summarized a little bit further on when Stephen talks about it. We now go from there to an $8 million Series C. All right, and you can see what's going on here. The pre-money is now set at $10 million. Now you may remember that the post money of the last round was $8 million. So these guys went away and they did another year's worth of work, and they got some new technology and they got some customers, and the company's really starting to move, and they say, look, this company's worth $10 million now. Okay. And there's the share price, when you do the math, and that's in the green, the sort of the dark green box in the middle, is $1.87.5. Okay, so they're going to put out 4.2 million new shares at $1.87.5. But the pre-money is 10 million divided by 5.33. That's where you get the $1.87. They're going to sell they're going to sell 4.2 million shares. All right. And they're going to end up with a post-money valuation of $18 million. Okay, this is actually a fairly common look. This is where for a Series C, some companies go, some companies may do, if they're making good progress, instead of that $10 million pre-money for the C round, you may see like a $25 million pre-round. In other words, if they've made a lot of progress, the pre-monies start going up pretty quickly. And why do the pre-monies go up quickly? Because if they feel that the company's making progress and sales are really starting to happen, they believe that the exit valuation they're going to be able to get for the company is much higher. And then they can realize some of that value in the share price. Okay, now, in our example, the way we work this Cherry Stone decides not to invest in the C round. And so what we end up with is a company valuation of $18 million post. You can go to the next slide. Now we get to a point where the company is ready to exit. Okay, and in much the same way that Jonathan described what we'd be looking at, we make assumptions here. The acquisition will take place in year 5. And we're saying that the company at that point is going to have revenues of $30 million. And we think that the industry exit multiple is a 3x of those revenues. 3x is for a company that's growing quickly, that's probably light. In the biomedical space, you might see revenue multiples of 6 or 7 or 8. All right. And you also can use, instead of just sales revenues, you can look at EBITDA multiples as well. But for the purposes of our example, we're saying its anticipated revenue will be 30 million. Industry exit multiple is 3. That means the company at sale will have a valuation of $90 million. All right. Now, this is where the math, this is where the sort of the more art version of valuation begins to bump into the quantitative. All right. If you have revenues and you have industry standards, that's when the quants are starting to crunch the numbers and saying, this is what the discounted value of visible future cash flows looks like. And the valuations start getting they start conforming to brighter line metrics. Whereas you may recall at the very beginning of this thing, we said, look, we got 2 entrepreneurs and we think the value of the company is $2.5 million. Now you're getting up to where it looks like 90. So Ella, go to the next slide, please, if you would. So this is what it looks like. The company, the acquisition of $90 million. Now you may recall from our last post money, there's basically 9.6 million shares outstanding. And this is what you get. You get $9.37 a share, okay, which is just, 90 million divided by the number of shares outstanding. Okay, if you want to go to the next slide. This is what the return multiples look like. And this is really where the angel math gets real. If you were in the series, and this is the overall investment multiple to all investors is 7.41 times. But if you were in the A round and you bought your stock, and I'm down at the bottom block here, sort of the second column over, if you bought your stock at $1.1250, okay, if you held on to that and you're in this sale, you made 8.33 times your initial investment. That's $9.37 over $1.12. If you bought your stock in the B round at $1.50 a share, you made 6.25 times. And if you were in the C round, Series C, and you bought at $1.8750, your multiple is a 5x. Now, most people go into the A round and then they sort of top up and they stay with the pro ratas in the B, and then they maybe put some in the C or not. The investment multiple is 7.41 on a blended basis. The thing to remember though is that that's a blend. Your own personal returns are going to be a function of where you put your money in and when you put your money in. All right, and that's very important to remember. Okay, Ella, you want to go to the next slide? And this is where so that's an example, and you can study it when you can get these slides when we do these, and you guys go back and go through the math on that, and you'll see it again. When Stephen talks about his part, he has the cap table for all this. But this is a very common progression for a company. There's no down rounds here. We didn't have any convertible notes other than the original one. So it was simplified in certain respects, but this is very characteristic of the way cap tables build up and what they look like on exit multiples. So I'm going to toss it over to Stephen now to take it, and he'll take you through a little bit on negotiation and the cap tables. Stephen,
Okay. We go to I've listened to all this, and I think we're not going to go through it in excruciating detail, but if you go to the next slide, the cap table is sort of like the report card, right? I mean, it's where we got everything laid out for us to look at, all the things we've been talking about. You can see, who all the owners are down usually down the first column, and you can, glean important things from that, right? You can see whether one founder owns more than another founder, or whether, how much other angel groups are in there and what they own, and you might see some celebrity on there, or you might, but that's why cap tables are interesting. First of all, is because you can see who all the owners are. And then you can, as this example goes, you can see the whole series of financings that a company, goes through. And at any point in time, in this case, you can see sort of the pre-funding and the Series A, and all the concepts that we just went through, where one can figure out, also, what classes of stock people own, right? And you can see kind of the amounts that people, each, if you go to the next one, Ella, you'll notice, here's how much was invested in the B, here's how much was invested in the C. It's the proceeds, and then it's the price per share, which is derived, as we saw earlier, by the pre-money divided by the shares out in the previous round. So you can follow the price per share. And I find all of that, is interesting. For example, if you can follow the option pool, and sometimes we get to a point in time with a company, I'm looking at one right now, there's no money, there's no shares left in the option pool. So you have to replenish the option pool, and that'll show up. If you go back again, Ella, you'll back to the previous slide, try to see what row that's on. Oh, maybe I can do it. No, I can't do it. But there's the option pool. It's right there, and it becomes. And if you go to the next slide, there it's 17%. But as it gets later and later, it's less and less. And this is an example. But one of the things you want to pay attention to is there enough in the option pool when we come in to incentivize the management team that's there. And then what the different groups own. We look at the option pool. You'll often see it broken out in terms of allocated and unallocated on the cap table, and that's important too. So I don't think for me, the cap table is sort of like, it's got everything. It's got all the information on it if it's laid out properly. And often we get cap tables where the founders haven't really. It doesn't look like this. We gotta recreate it. We gotta show them how it has to look. Nothing we can't do a little Excel, and then you can do some modeling with your cap tables and say, hey, what if the pre-money price? You'll often see, you'll see one coming out soon on Hilltop, where you'll see the assumptions at the top. You'll see the pre-money, and then it generates the per share, and then you can see what the per share this round is versus the Series C, and you can see the difference. And I often model it and then point out to the entrepreneur founder that it doesn't make a huge difference to their ownership stake when you have slight differences in the pre-money valuation. So all of this is what the cap table modeling enables you to do as part of your negotiations when you play with those inputs. And then you can also point out to them, well, I think we need more in the option pool or we don't, and that kind of thing. So, you know, we've been going at this for a while. I think we ought to, you know, I don't know, Ella, if we were going to take questions here at the end. But, you know, I didn't want to go through every single.
So, yeah,
We've got Alan's portion too here.
Oh, and we got Alan. Over to Alan.
all right.
Just one comment. There's a couple of more slides in there which actually show the cap tables associated with the example that I went through. And so people are ready. You can see
Another
the
example.
explanation, and then the cap tables as they evolve are shown here in slides
Yeah.
26 and 27.
Ella, are you putting this, are you sending this out to everybody?
I will, yes.
Okay. Great.
And yeah, and we'll have also the recording available. All right, so Alan, would you share yours?
Well said. So there's I'm going to share a lot of data here. There's a lot of detail, which I wouldn't ordinarily put in a slideshow, but we are going to distribute it out. And I think you may want to read some of this more detail, even things I don't talk about at your own leisure, because some of the information we see in here, it was pretty eye-opening for me. And I'm in this day to day. It's pretty shocking. So the Halo report that we're going to look at, this was from data from 2019, which was pulled together in 2020. And there's over 2,000 deals that they use. So it's a pretty broad spectrum. Let me go back. So first off, where are the deals getting done? You know, we have this misconception in the Northeast that we're everything. But when you start to look at the data and where the deals are actually getting done, we are just a small component of the number of angel deals that get done. Obviously, there are a lot in California, as you can see, but surprising to me was how many deals get done in the Southeast and actually in New York. And they actually dwarf the Northeast. So that was pretty surprising to me. And when you see the number of deals that get done in each region, and that is, if you look at where the investors are located and how often they invest outside their own region. We in the Northeast, not surprising to me, 77% of our deals are done in the Northeast. But if you go down to California, it's only 62% of the Californian investors are investing in California. And in New York, only 36% of New York investors invest in New York. So pretty stark differences as you look around the country in different regions. Deal structure. So we see, you know, a couple of my colleagues spoke earlier about deal structure and what it looks like. Ella talked about different types of securities. Very interesting. Seed rounds, only 4% of seed rounds are common stock, 50% are convertible notes, and 41% are preferred stock, with SAFEs only being 4.5%. So again, big picture, 50% notes, 41% convertible stocks, that's 92% of all the deals get invested in the seed round in that format. SAFEs, which we hear a lot about, the investors are kind of banging on our door. We think they're hearing this from California, particularly from Y Combinator. They're not very attractive at all to the investors, and some people won't even invest in them, me included. They're just not appealing at all. And they're really not that prevalent, which is kind of interesting in this. This report largely talks about, really they're based around the DC area where there's federal money that prohibits any type of debt on the company. Those are where the SAFEs are actually taking place. So that was pretty interesting. Once you get to a Series A, most of the investments are done in price rounds. 86% of preferred stock, 12% in common stock. 12% in convertible notes. So once you get to the Series A, you're probably going to see a priced round and not a note even with a cap. This is the part that kind of blew me away. And these are the overall valuations by stage. So let me just walk you through this. There's 4 numbers that are important. There's an average of pre-money and a median of pre-money. And I would argue that the average really isn't important for us because you get some huge, big West Coast companies that kind of skew the average. If we look at the median, it's a little more pertinent for us. And if you look at the median value of a seed round, is that bottom bar on the left, the fourth one down, 6.5 million is what we're seeing the median value of a seed round is. I look back at my notes when we did this seminar 2 years ago, that number was 3.5 million. So you can see how much these are being driven up. There's a lot of money out there. Somebody had mentioned earlier, when you look at the returns that you get in a safe investment, they're pretty lousy. So you're starting to see some of this money filter into the angel world in pushing up the valuations, frankly, higher than many of us are comfortable with. If you've ever sat in a screening and we beat up some of the investors, some of the founders, this is higher than I think we would see as a median number. But nevertheless, these are the national numbers. When you get to the Series A round, the median value is 10.6 million, which seems to make a little bit more sense. Then the bottom half of this graph talks about the how big the investment is by type of by the round size. So you can see if you go from the bottom up, the seed round, the median round size is $600,000. And the median investment from one group would be 400,000. If you go up to the Series A, that median round goes up to 3 million. And the median investment from a group goes to 1.2 million. So not that surprising. I think the 600,000, we would all say, yeah, that sounds right for a seed round, and 3 million on a Series A probably sounds about right. So that really wasn't as surprising. Interesting though, when you look at they try to trend here, the pre-money valuations for both median and in the average. So again, these are averages, but you can see how much they've gone up just looking at the bar charts on the left. The median on the bottom, in 18, it was 5 million. As I said, in 17, it was 3.5 million. Now it's 6.5 million. That's almost a double in 2 years. Really interesting. And when you get to the Series A though, it's not increasing so much. It goes from 10 million in 18 to 10.6 million in 19. So things level out eventually, but obviously there is an impact to your return if you're investing at a higher pre-money on the seed round. Industry segment, where's the money being invested? Where are angels investing money? We can see from this graph, 29% of the money is going to technology. And this is a hard one because sometimes we see technology in healthcare. It's hard to differentiate in some of the med tech investments we see, but technology, 29%, consumer products, 25%, usually B2C here. Healthcare, and I think if you look at healthcare and biotech together, it's about 21%. And then B2B, it's 16%. But no surprise, technology leads the way here. This slide, I'm not going to go into in detail for the sake of time, but this is interesting for you to read and see what the valuations are in different industries. And they do vary a bit with pre-money in Series A and in biotech, much higher than you'll see in technology. Again, these are national statistics, a different way to look at where the money is being invested. And I'll leave that to you to do at your convenience. And then this last slide is about the Northeast only. So those were national trends. In the Northeast, the median seed rounded again is 6.5 million. It's still there. Interestingly enough, and I don't know how this works, the median Series A round is 6.2 million. So that's a little bit of a surprise, and you have to dig in a little bit, but we are talking about medians and averages, so it's a little bit different. Similarly, on the seed round, you see the we're pretty much on board with the same as the national averages. New versus follow-on. If you look at all the money angels that are investing, 55% is new money and 45% is follow-on rounds. And again, deal structure in the Northeast, very similar to the national trends. 48% preferred, 45% convertible note, and only 6% safe. So interesting. I'll leave this to you to look at it at your convenience. There's an interesting article here I also included, which we'll include in the deck. But I did just want to mention a couple more things as we before we take any more questions. And the first would be there are tax issues that have come up, and they've actually been in the spotlight because of Biden's tax proposal. And just to be aware, Cherry Stone will not offer tax advice, but we will mention a couple things for you to check with your tax advisor on. One is Section 1202 stock. And 1202 stock is stock that's originally issued by a company in a C Corp that you hold for 5 years, and you can avoid taxation on the capital gain if in fact you exit after that 5-year period. Very, very attractive. It actually goes back to the Clinton years. It was beefed up under Obama. The percentage exempt went from 50% to 75% to 100%. That is not on the chopping block as so far with what we've seen, but who knows what happens once it goes through the grinder of Congress. But something for you to keep an eye out. The other thing you want to make sure you have an eye out is Ella talked a little bit about preferred dividends and interest on convertible debt. When that is paid out and converted into equity, it is taxable. So you could, in fact, have some taxable income with no cash. So you just want to plan for that as you're investing. I can't tell you how many clients call us and say, hey, I got this 1099. How come I owe this money on this interest? I never really got it. Well, you did get it. It just got converted to stock. So keep your eyes open. There's a lot of tax issues that come up in angel investing, and you just want to be prepared for that. So,
Alan, thank you very much. We have time for some questions.
Yeah, I was just gonna throw out, I mean, it seems like you might be a CPA firm. Are there like CPAs that people use in Rhode Island for this? Because is it doing Section 1202 and stuff is a little different than the guys I've used in the past. And
yeah, funny you should mention that, John. I think we can probably help you with KLR.
all right, so
Happy to talk
that's
to you or anybody else offline.
all right.
Alan,
Yes,
is
Sarah.
there any theory as to why, or what did you see as the rationale for why there was a doubling in the seed round price? Did you see a rationale for that?
I think, Sarah, the only thing it shocked me when I saw that statistic initially. The only thing I can see is that there's just a lot of money out there looking for a home. And as we've seen yields in banks and fixed income being so low, more investors are willing to take more risk. And it's just driving up the price. It's a simple supply and demand equation.
Yeah,
Yeah,
Sarah,
I'll be interested. Oh,
there's another factor too, which is in the biotech sector. Companies a lot of these companies, as you're aware, get a lot of grant money early on, NIH money, SBIRs and other things. And companies that come to the market with their seed rounds that have had a lot of grant funding will typically carry much higher valuations simply because they say, look, there's, even though it's not dilutive, there's a lot of value that's been created in the company. And I think that's been driving up the valuation, certainly in the biotech sector, but also in some of the other areas.
that's a good point. It'll be interesting to see if that all carries forward and that you see in subsequent reports that the Series A rounds, go up higher. I mean, I was struck by it's kind of flat between the seed and A, so interesting.
Wonder how much of
That's the
that in the
moment.
Northeast in particular is just the sample size that could be impacting the median or the that
Nomenclature, something
Well,
you call.
ultimately, if, we've seen the emergence of the SPAC world and some of the valuations there, that a lot of that's tech, but these guys are looking for deals. If they keep driving up terminal valuations or transaction valuations at the other end, that's going to feed back in to early stage valuations, because people are going to say, hey, look, if you thought you had to get $100 million exit to justify a 6 or 8x on the first 2 or 3 rounds, and suddenly they're saying that $100 million is 250. Well, guess what? The entrepreneurs are going to start demanding higher valuations in the early rounds. Do that. It's very much a fluid moving situation. And that's the way the valuation discussions work between the entrepreneurs and the early funding groups.
Yeah, I saw an article this week. I'll find it and we can send it around to the group, how more PE are getting into early stage. I can't remember where I saw it, but I think it's almost a 5 to 7% change over the last 10 years, where private equity money is getting growth capital, is getting into early stage capital, which skews the valuations.
Alan, you can probably get data to look at the other end of the spectrum. And that might be an interesting exercise for another one of these sessions, is to look at the number of exits, the valuations around those exits, the time frame for those exits, the different categories of industry that those exits occur in. It may be a depressing exercise, but it'd be a very useful exercise, and see whether there's any correlation between the early valuation metrics and what's actually seen in the real world when we do finally get exits.
That's a great idea, Alan. Other questions?
Yeah, I've got one. So it's my understanding that on the 1202 certification that there's a need to get some type of written documentation from the corporation or the founders of the business to ensure that it's a qualified investment and you've got that in your portfolio or your folder. Is that something that we request when of an investment into a company when we're making an investment as Cherrystone, or is that an individual thing?
It's really, so 2 things, Hank. One is that's frequently found on the 1099. So it's not unusual to have the 1202 reported on the 1099. Unfortunately, it's frequently reported incorrectly. I just went through one of these and it was not reported correctly by the company. And then it comes down to the individual who owns the stock saying that they held it for the 5 years. And it's generally the holding period that's the sticky issue. There are some nuances around 1202. The company can't be capitalized. I think it's in excess of $50 million.
Right.
Has to be original issue equity. It can't be an LLC. There are some nuances around it, but it's pretty much up to the investor to make sure they're tracking, because these companies, remember, by the time you get audited, they're long gone. So to me, I think you're right. You want to get the documentation, but I think the onus is on the investor to make sure they have the appropriate documentation.
Yeah, just as an aside, there is, we have learned over the years that the average holding period for these companies to get up to exit is closer to 7 to 8 years, longer in some cases than the original 4 to 5. But this 1202 is a huge issue. There is no substitute for keeping good records yourself.
Yeah.
For having dates, original basis, actual invested amounts, any paybacks, or as Alan talks about, any accumulated dividends that have come up that have converted. You have to keep track of all that stuff, because when you get to a point where you have an investment that you've held for 7 years and it's qualified 1202 stock, the value, the original capitalization was under $50 million, all that kind of stuff. The tax effect of being able to qualify for 1202 is absolutely enormous.
Yeah, right.
And so, and it gets back to the fact, as Alan's exactly right, nobody's going to do the accounting for you. You have to have the records to be able to justify it.
One thing I think that most angel groups do require is that the company will be incorporated and not be an LLC, because the time really starts from the time that it is incorporated, because LLCs are excluded.
Yeah.
So this is something that's the reasoning behind a lot of the requests that companies will be incorporated.
Yeah, we do not do investments in LLCs. So they won't get through our screening. Other questions? We will be circulating there's a lot of material here, and we appreciate everybody taking the time. And there's the material bears study at your leisure. But we're hopeful that this will allow everybody to get much more familiar with a lot of the terms that you hear kicked around in meetings as we're talking about how a deal is progressing and what the entrepreneurs are thinking, what the term sheet says. When we start talking about a B round with an up round this or a down round that, or anti-dilution provisions, you can you can get a sense of what it's all about. But any further questions, please reach out to any of the presenters. Right. I want a big thanks to everybody who helped with the preparation, to Dan, Ella, Jonathan, Stephen, and Alan. Great work, guys, everybody. And like I say, questions back to any of us at any time.
Thank you so much. It was great to see everyone.
Yeah, thanks. Good job.
Thank you very much.
Great job,
That's a wrap.
everybody. Thank you.